Hi, everyone, and welcome to the macro and global liquidity analysis, gold, silver, and Bitcoin update for September 2024. We're putting this presentation together for our value clients of the Ainslie Group, including Ainslie Bullion, Ainslie Crypto, and the Gold and Silver Standard. As per usual, I would like to start by welcoming our expert panel today, Joey and Paul. How are you going this month, gentlemen?
Very good, Chris.
Good, Chris. Great to see you again.
Good to see you. Now, it feels like this month has gone quite quickly, but at the same time, it feels like a lot has happened. I want to get into all of that in just 1 second. But before we do, just a reminder to everyone that everything said and shown in this presentation is intended for general informational purposes, does not take into account your particular circumstances, objectives, or situation, is not financial advice, and you should always do your own research and consider obtaining independent advice before making any investment decisions. All right, with that out of the way, we'll follow our usual format, big picture, global macro, digging into the global liquidity cycle, which is where we believe the real juice from all this is coming. Other indicators we think support where we are in the cycles, talk about Bitcoin, gold, and silver, and end up with our simple trading plan to take advantage of the cycles. As I was saying, lots feels like it's happened this month. September is a notoriously terrible month for the markets. Joe, I'll probably start off with you on this one. We've been talking about it a lot internally, usually very bad, but doesn't actually seem like it's been that bad this time around. Is this a sign of good things to come? What's your take on September?
Yeah, 100%. It's seasonally, September's usually very bad. I would say maybe everyone might have just front run it this year and we just had it in August instead. So, if you looking at all the assets, particularly what we're going to talk about today, gold, silver, and Bitcoin, it really, well, gold and silver in particular performed really well so far, and we don't think Bitcoin's too far behind. So, yeah, to this chart, we're still in that mid cycle. If you're looking from like a global growth point of view, the global economy is not particularly hammering, which is not actually a bad thing. It's a little bit sluggish, so we'll be looking to stimulate through the rest of the year, particularly when we look at seasonality for the last quarter of the year. It usually is very quite a good period for risk markets.
Paul, what's your take on this generally? I mean, it feels like it's been a long process, sort of etching out this bottom here that we've seen. I mean, we're in the mid-cycle sort of hanging on there, but we haven't crossed the 50 line yet. We're starting to see action from the Fed and central banks in terms of cutting rates and all of that sort of stuff. Ultimately, do you see that as a good thing? Is it that we've got a bit further to go, but that's still overall positive? What's your take?
Yeah, look, the Fed has done a good job at jawboning. So everyone was expecting the 50 cut. Whether they needed to do 50 is arguable, but they did 50 to send a clear message, right? So I think we've got the combination of it being an election year in the US, which is always supportive of markets. I will remind us that we're mid-September, so it ain't over. But then that lumpiness, as we've discussed before, a lot of that has been China really struggling, economically, but also tightening from a monetary point of view, from a liquidity point of view, and that's certainly been a drag on the market. So now that they somewhat erratically are easing, we're certainly starting to see that all align. Likewise, ECB, cutting rates as well. So all the signs are that the easing to come, but it's still early days.
And such a good point about China that I had an extra chart which I didn't put in today, which really showed what global liquidity, which is the next thing we'll talk about here, looked like when you took China out. And it's very much not like back on a normal trajectory and much higher. China really has been that lag there, but ultimately possibly the thing that really pushes the liquidity higher, because they seem to have given up on defending the yuan and now are spending much more time actually trying to actively manage and dig themselves out of that hole, which is quite possibly a good thing for liquidity overall. We bring this chart up just to look at the longer term pattern and remind us that it's really not abnormal. I mean, Joe, you'd probably say that here. If you really look at this, it's not an abnormal picture at all when you zoom out a bit.
No, it's probably not, hasn't come, the liquidity probably hasn't come as quick as some people might have thought, but as we've discussed before, we've gone through quite an inflationary period, and central banks and governments weren't eager to stimulate as quickly, just because there was a lot of pressure on them not to stoke the flames of inflation again. So, but over the last 6 months, we've had a pretty choppy time, and particularly talking about Bitcoin, gold, and silver have done well, but a lot of people are worried about recession, and the bears have all come out, and we've stuck to liquidity is going to turn up, and assets going to do well, and it's certainly starting to look that way.
Chris, it's probably time to remember that over the last 20 years, those 3 red dots, each has been, sorry, 4 red dots, each has been a refinancing crisis, right?
Yes.
So, and whether there's an element of being prepared going on, but we also saw the change to the banking reserve rules in the US as well, just to help them along any stress that might come out of this tightening.
And that's really interesting because absolutely there's a lot of, let's say, not really obvious manipulation going on behind the scenes here to keep the liquidity sort of coming through, not necessarily in the traditional means. And what was that one? It was something to do with changing the bank reserve requirements again, or something's that there's stuff at play all the time at the moment to try and really ensure that we don't end up in this crisis, or that we are properly out of that crisis mode happening by the central banks, particularly in the US.
Yeah, which is de facto increasing liquidity. They just increase the capacity of the banks, so that just means more liquidity for investment. And
just on this chart, we do have the detailed breakdown of what was sort of going on right through that people can access on X, or look closer at it sort of from the video and in the notes and whatnot. But that's worth having a look at if you haven't sort of studied that very popular chart. Going on to look specifically at where we are in this cycle. So we've got sort of 2012 to 2018, bit of a choppy cycle, the really clear cycle that we had, sort of the COVID cycle, we could call it, culminating in 2020 there, and the chart cycle we're in now, up and to the right should be where we're heading from here. I think that's looking increasingly likely, even though it's being slow to take off. We were discussing quite a bit this week the actual components that make up that global liquidity, and really interesting. Probably Paul, I'll ask you about this one, but really interesting that we've had a big pickup here in the world collateral pool, or bonds generally. How do you explain that? Is it really just that because of the expectations of rates coming down, it's really boosted the value of bonds and really helped that out there?
Yeah, it's boosted. And look, let's not forget that black down the bottom first. That's the fixation of people on central bank liquidity being global liquidity is clearly mapped out as erroneous there, and it is flat. So I seem to be talking about all this easing. That's just interest rates. There's a whole lot of other factors, and the reality is most central banks are actually pretty neutral at the moment. If it wasn't for China and Japan, then that would almost be in a decline. So central banks are definitely a substantial part of it, but they still have a lot of room to go before they start easing and really adding to the liquidity. But to your point about that orange or tan line, that's really a factor of a number of things. So we have had the bonds, the actual value of the bonds going up as interest rates go down or the yields go down. They've been somewhat stable, but still at the higher end of that. So again, plenty of upside to go. And those lower rates in the US also mean a lower US dollar. So a lower US dollar effectively adds liquidity to global holders of US debt, which is the world. And so we've got quite a substantial uptick in that as well. So that it's all adding up, as you can see, is up and to the right. It just keeps going to, we're in the mid 170s of trillions now, which is just a phenomenal number.
And Joe, I'll come back to you on that a little bit later because I want to talk about the move index, because I know you've been looking at that specifically. But the point that you just made, Paul, the black line here, the central banks, they really have not been contributing yet. So it's so interesting that a lot of people, when they look at the concept of global liquidity, miss the point that it's not just what the central banks are doing. If they're looking at that, this probably explains a lot of the confusion, particularly when you look at on platforms like X, where people are back and forward and they're debating what's going on with liquidity and what they expect next, and crashes, and the central banks aren't contributing. Well, they're missing a big part of the picture. So it's really important part of what we do here is to make sure we're trying to look at the whole picture, because it just doesn't show everything there. However, when we do look specifically at central bank liquidity, we've got plenty of green starting to emerge there. Joe, we talked about this last month as well. We're clearly past the red. I mean, there's no denying now that we're in the neutral to easing part of this phase, and the expectation being more green ahead.
Yeah, and I'd call it exactly that, just basically a neutral stance at the moment. So these cycles go on for 4 to 6 years. So as you can see, that red part of the cycle went for approximately 2 years, and coming out of it, we would expect it to go from a neutral into the green for at least another 12 months.
And everything lines up there beautifully. We've been calling that for a long time, and to see it unfolding like this is excellent. Exactly what we're after. So now we'll have a look specifically at US growth and inflation. We make the point very regularly: US is not the world, but it is a significant, or the most significant contributor to what we see happening around the world in terms of global liquidity, global macro. We were a bit not. We were expecting maybe a little bit better numbers this month out of the ISM, particularly in the manufacturing side of things. Not so great. Joe, do you want to maybe talk about this a little bit? I'll flip over to the next one too, with our 3-month leading indicator pointing down here, but it's really sort of on the line, 50-50. What's your interpretation?
That 3-month indicator is going to be quite volatile, because it's looking at a further 2 months on top of our 1-month indicator, obviously. So in my eyes, that's probably likely going to turn up next month. We won't see a sharp decline down, particularly since we're looking US centric here. We've had the Fed just cut rates, which will take time to flow through to the economy. As we've said, these things take time to actually work their way through. So easier money will drive more consumption, particularly in servicing, manufacturing, and in the next couple of months, we would actually expect that to be the bottom in terms of the indicator there, and ticking up into early next year, maybe December even this year.
And a lot of things that we don't display here, other indicators that we've been looking at, sort of lead to that conclusion as well. The other side of the equation is not just growth, is the inflation one. Paul, you mentioned it before. It's really not an issue right now, and people don't necessarily like to hear that, because they feel it at home, they feel it in their pocket, inflation. But what they're feeling is probably the inflation that's already being, not where we are right now in the cycle. Is that how you view it?
Yeah, I think so. And the lack of wage growth is been a big part of that as well. But this shouldn't be a surprise. We're in a lull, in terms of the ISMs that we just saw. So once the economy picks up, and then you start to get the demand, that's when you start to get an uptick of inflation. But when you're looking at that true inflation there of around 1.1%, then we're clearly bottoming at the moment. So we've got that combination of that lackluster ISM, low inflation. It's everything the Fed needed, combined with choppy but still fairly ordinary unemployment figures out of the US. They've got what they need now to turn to easing.
And Joe, you're probably going to say the thing I'm about to ask you. You're probably going to say, let me guess, that it's not a bad thing for inflation to tick up from here. Is that what you're going to say?
Not quite. But to Paul's point, it's given the Fed cover for to cut rates. So, and then leading into an economic expansion where inflation picks up due to you got the price of commodities starts to tick up, and then it comes into goods, and then it flows through into wages, and that's when you really start see the inflation again. When it picks up when you see in wages, that's when people really start to notice it, right? Businesses start charging more for services and goods, and then it's just a self-reinforcing cycle. But what I was going to say was, even though we've really seen the inflation level out here, there will, I believe, 12 to 24 months, we will start to see inflation pick up again. It will start to be a problem. But that's not where we are now. We've got to we are looking a little bit in front of where we are at the moment. But I do think that the age of inflation sitting at, well, it's not going to sit at 1%, that's for sure, over the next 12 to 24 months with the monetary expansion and stimulus that is coming. So,
but it's not necessarily, from the way we're looking at it, like bad thing for your
right
pocket, but not necessarily a bad thing to see that ticking up a little bit in terms of asset prices. And it doesn't mean we're heading straight into a recession or anything like that, because usually, as you just pointed out, that will be on the back of increasing growth. So it's overall going to be a good thing.
It really look at everything we're saying in terms of, this is a market that's for all the doom and gloom that's there on X and headlines elsewhere. Yes, it's soft, but it's clearly close to 50. It's clearly close to expansion. That trajectory is still reasonably up and to the right. And then as you go, and you can still see services ISM was higher than manufacturing. So as we turn to a rebounding economy, albeit juiced off liquidity, then we'll start to see manufacturing tick up and actually overtake services, and then that late cycle when services tends to pick up. So it all reinforces what we're saying is, the sky's not falling down, the liquidity's coming, and we'll start to see the ISM and inflation start to tick up in response.
And all of that, again, is what we're here to do, is to find things that reinforce our position or tell us that we're wrong. That's what we're looking for. Along that line of thought, we also need to look at US government debt yields, the dollar, because these are key drivers. Now, big news in the last sort of week that we've had that cut in rates, 50 basis point cut. You can see that falling off the edge there. Not dissimilar in time to what we experienced back in the mid sort of 2000 area there. Very similar timing. Pull back. If we zoom in a little bit closer, it's what we've been talking about and expecting for a long time. Joe, what's your interpretation here? Just before, or as part of your answer, I've had some people say, the bonds, the yields are rocketing higher after the announcement.
Yeah.
It doesn't look like a rocket higher to me, but maybe I just need to zoom in a little bit further. But what's your interpretation of, first of all, the rate cut, but also what we've seen in reaction from the yields from that?
Well, the market had the 50 basis points priced in for quite a few weeks before it took place. So there was obviously a lot of front running there. There's a little bit of a sell the news event, which we've had a small tick up. It's nothing uncommon. It's not going to go straight down and then hold flat. It's not how markets generally trade. In terms of the rate cut itself, possibly the Fed are really trying to nail that soft landing. So they're trying to get ahead of any unemployment that's going to tick up. Now they've got inflation under control. They're quite happy with that. To say whether it was the right or the wrong move, it's hard to say at this point in time. We won't know. They'll only be in hindsight. Particularly, I was looking at the futures market for November in terms of rate cuts, and they're also pricing another 50% chance of a 50 basis point cut. So it looks like it's going to be a fairly aggressive cutting cycle in terms of, like, when you consider that the economy is not actually falling off a cliff. Yeah, it's a little bit sluggish, but GDP is not too bad. Employment's a little bit high at 4.2, but historically that's actually not too bad. Inflation, unemployment isn't rocketing higher yet. So the only way I'm reading this at the moment is they're really trying to nail that soft landing and get ahead of it. Whereas in the past, they've always been a little bit reactive as opposed to proactive.
Paul,
we're also starting to see a more normal yield curve. We've noticed the 5 years, the 5 years the only one not behaving. All highly orchestrated, as we've spoken to, in terms of just the amount of issuance of that short end to pay for their huge deficit. So not an organic yield curve, but it's still starting to be more normal. But look at the chasm between, 4.8, the Fed fund rate, and down to 3.5, 3.6. It's a long way to go. So
that should have a good % or two difference to actually have a positive encouragement for you to even take on that risk. At the moment, it still doesn't make sense, does it?
No, but again, just the sheer scale of that issuance of 2-year bonds to pay for deficits has suppressed the 10-year. So it's effectively a curve control, but it's certainly, and we talk about this new paradigm or regime of fiscal dominance, and that's it playing out at large right there.
So what's your interpretation if we go from what we can see here, a clear, as Joe said, rate cut trajectory ahead? What's your interpretation then, Paul, of how the dollar's behaving here? Is it about to break down lower? Do we get a bounce? How do you view this?
Look, as just looking at that technically, and you've even put that green arrow at 35. Been a lot of red. You'd expect a bounce, but geez, there's a lot of pressure down. So yeah, and if we actually almost touched it, if we do see that break of 100, it could be very interesting, and that is so supportive of liquidity globally. So it's it doesn't make sense for it to bounce unless, as Joey's saying, there's a bit of buy the rumor, sell the fact. But I personally expect to see some more downside on the US dollar.
Joe, it's a few weeks into where we were saying potentially was the cycle low there when we talk about a 26-week cycle. And it really hasn't shown a lot of strength. Is that probably a fairly negative sign for the dollar, that if it can't bounce here when really it's had a good opportunity to recover, that it's doomed to go lower? Is that your take?
Well, it's definitely going to be an interesting week this week in terms of currencies and how they trade. If we don't, I would have, exactly like Paul said, expected a decent bounce here. But if we don't get that bounce, then you got to remember that the US dollar trades closely on interest rate differentials, right? So if the market's expecting large rate cuts in the next Fed meeting, which is in November, which is still a while away, they're gonna price that now, and that's going to drive the dollar lower. So, yeah, if you can pick bonds, you can pick the currency, and I think, yeah, if those rate cuts are coming, we should see a lower dollar and looser financial conditions and higher asset prices.
And interestingly, you mentioned the Chinese, defending the yuan earlier, so they were worried about loosening and that they would devalue the yuan and they'd have capital outflows, but the yuan strengthened, right?
Yes.
So they've done all this easing, and quite substantial easing. There's a big reversal of pace, but we're looking at part of the reason there, right? So the US dollar falling is helping that, but that will embolden the Chinese. You would think that their main fear was about the yuan, and they've loosened to that extent, and it's actually strengthened. And that could be off people just thinking that it's going to stimulate the economy and it'll be stronger. But it's an interesting dynamic. It has a lot of knock-on effects, this US dollar.
Well, it's certainly going to hurt their exports. If their own currency is strengthening relatively to everyone else's, which is what it's been doing, it does give them cover to effectively stimulate, which is liquidity positive. So it probably is. I think it's just going to take a bit of time for that to come through, but it will happen. I don't imagine they don't really want a weak yuan, but they also don't want a strong yuan.
No.
So zooming in a little bit, if we look at the weekly global liquidity, which we just do to see if that supports the bigger picture stuff we've been looking at, we've seen a little bit. Well, it's been really quite a choppy year, to be honest. We had that initial sort of big move higher at the end of last year, and then been all over the place. But it seems like we're breaking out of that now, just consistently making new highs. Paul. We've seen. Well, that is aligned with our expectations. Do you think that really lines up with what we have seen? Because when you look at this, remember, this is in nominal terms, and the index itself is still just coming off that low. This would tend to tell me that the number could end up quite a bit higher over the course of this cycle.
Yeah, absolutely. So it's been, we've talked about it for months now, this lumpy bottom. We're now starting to see very clear a lot of the inputs aligning, so that it's been struggling against central banks tightening and bond volatility, and there's been a whole host of things at play, but that all seems to be turning towards a further loosening. And just we've got to remember the scale. Look at that, the bottom in sort of June, July, we're up $5 trillion globally, right, of extra money flowing in the system. And for context, the New York Stock Exchange on a strong day might do 100 billion. So it's just a phenomenal amount of money, and as you're alluding, I think it's just beginning. So we're coming out of that choppy bottom, and I think we've got a bit of clear air from here.
And such a good point. People miss that really important magnitude. Like it's so large, which leads me back to something I wanted to ask you about, Joe, that we talked about earlier when we were looking at that sort of big chunk in the middle of the constituents. So you look at the central bank stuff at the bottom, and then looking at what's happening with collateral in the system, which is why these numbers get so large. This is the MOVE index. I put this in here today because it really struck me when I was looking at it that we've actually spent quite a lot of time with quite high volatility in the bond market. Can you maybe talk us through this, and also what it might mean, the fact that we're still above this normal zone? Are we heading back down there? And if so, what does that mean for liquidity generally?
In terms of what the authorities want to happen, they would definitely like that bond volatility to be suppressed. So it's basically just the more volatility that's in an asset, the less likely, or the more of a haircut that is given to that asset if you want to borrow against it, right? So if you, for example, had $1 million house and you wanted to take some equity out of it, if the price of the house jumped around 30% every day on the market, the bank's not going to give you. They might give you a couple of $100,000 as opposed to 700,000 or 800,000 to borrow against it. It's just the same with bonds. If you look back to 2020 when COVID hit, so we had that massive spike in volatility there. So and bonds sold off, and even though they eventually quickly came down, that affected global markets. Everything sold off. Everyone panicked because volatility in the bond market's real. That's the risk free is the US bond market, right? So after COVID, we were even well below that normal zone for a while as the Fed really suppressed bond volatility through QE and effectively just taking all the volatility out of it just to stabilize markets. So, we're going to flow through to 2022, and the Fed started its QT program, so the opposite of QE. So it was actually letting bonds roll off, which meant there wasn't a buyer there in the market constantly buying, which drove. We also had inflationary pressures, which scared investors as well. So bond prices fell or the yield went up, which caused basically a self-reinforcing cycle where we just had a lot of volatility because of volatility effectively. Since then, we've stepped in, the US Treasury stepped in and started what they call a bond buying program, a buyback program. So they're issuing short dated and buying longer dated ones, take some of the volatility out of the bond market. And also the Fed has reduced its QT. So it's not selling as many bonds into the market on a net basis. So going forward as well, I was possibly expecting it to occur during this Fed meeting, but it may end up happening next Fed meeting or towards the start of next year. That the QT program may well be ended, and QE might even start depending on how markets are looking, which would drive that bond volatility lower and be fantastic for collateral bond prices and collateral multiplier, which means there's more money in the system, more liquidity.
Excellent explanation of all that, and I think it's really interesting or important to watch that, because this is a measure that not everyone is paying attention to, but you can clearly see us sitting above that normal zone, that there's more potential for it to come lower. And certainly it's called the normal zone for a reason, right? Like that's where we're supposed to be, or generally where they'll be trying to target. So it's not unreasonable to expect that we see further reduction in that volatility ahead. So that makes a lot of sense, and that's very exciting from a liquidity standpoint.
I'll add, and it's only sort of just come to me, so I haven't tested this, but I wonder too whether the market, that 60-40 portfolio was shown to be bad, right? And we talked about this again, this change into a fiscal dominance regime where the 60-40 is dead for a while. There could be an element of that at play too, in terms of people, and that's just going to mean that the central banks are going to have to step up even more. Hence, Joey's point, we come back to QE rather than QT to get artificially get that back down to that normal zone. So I just don't know whether we're in a new normal, whether that
exactly to your point. Let's not forget that there's a whole lot of retiring people who are relying on 60-40. And this is the death of, this is why it hasn't worked. It's not a surprise it hasn't worked when you've had the volatility right up here for so long. So there's a lot of pressure, isn't there, on governments to ensure that comes down, because if their pension's not coming from their 60/40 portfolio, then it's coming from the government spending. So it's not in their interest to have the volatility high.
And that's when you get into the thesis, and that's a, let's be real, a late in the cycle phenomenon where you may actually see an engineered recession, because all this has been just trying to avoid a recession, right? So they just keep pumping it with liquidity to avoid a recession, but they may get to a point where they just actually orchestrate one to have people exit all their risk on shares and go into the safety of bonds, so they can get those interest rates down and service all this debt. So we could see this play out up there for a little while, trying to get it down to the normal zone, or we get, like inflation, a new normal.
So help me if you're responsible for the recession we had to have Mark II, Paul. Okay, so let's start. We turn from that. We've sort of done that big analysis. We know where we think we're heading. Let's look at specifically Bitcoin, gold, silver, where we should be. We've talked about the link before, global liquidity and world wealth. It's pretty clear there that there's a correlation. We've pointed this out many times. So I'll skip through this fairly quickly to get to specifically talking about the assets. But we know we've had this conversation many times as well. Monetary inflation hedges, when you think about gold and Bitcoin specifically, versus the global liquidity that's just up and to the right constantly over the long term, doesn't even come close to CPI. People looking at the wrong thing. We've made that point. I'll skip through this as well, but
Chris, if we can just go back to that, because I heard an interview the other day, and it gave great insight into, because we've spoken at large about the difference between the dotted line and the black line, right? It's but the gentleman's name, I can't remember, it was saying that over the last 40 years, which is where we've had this financial dominance of generally a channel of falling interest rates. So we've had, on average, in the US, GDP around 1.75%, and over the same period, wage growth was 0.7%. So you had this 1% difference that was basically compounding every year, going into the pockets of the top 0.1% that actually hold the assets that benefit from all of that. And likewise, that suppresses CPI in effect, because it's going into those few and into assets rather than into the economy. So it was an interesting observation, again, to explain just that disconnect between high street or main street inflation, CPI, and monetary asset inflation.
And
so it just reinforces you need to own these assets to
reinforce that point. You said something really important there, that when it goes into the hands of the pointy end, the top 1%, it's not inflationary. Can you just explain that?
It's absolutely inflationary for those assets.
Asset price inflation, yes.
So asset price inflation, but because that money is going into those hands, and they're not, that's not putting demand in the economy, that would drive up the inflation. So it's just simply the rich get richer and the rest get left behind.
And the rich aren't spending more on core goods.
No, they're so they'll buy the odd Lamborghini or whatever it might be, but that's not CPI.
Not part of the basket.
So it's and you don't, the top 1% is not Lamborghini buyers. Like that is still a large number of people that are just at the top end. But it's just so disproportionate in terms of, when you own the assets, what you're getting, because you have that discretion, that it just doesn't go into the economy. It just drives the asset price higher. So
that should be all the explanation anyone needs to get their hands on some of these assets that are actually keeping up with what we need to be in the top 1%. Joe, the Bitcoin one here, when we look at that weekly global liquidity, seems like it's following. Is this the catch up we were talking about last month?
I wouldn't say it's the catch up yet. It's certainly looking like it will catch up. I think we've spoken about seasonality, particularly in the last quarter. For Bitcoin, seasonality last quarter of the year is generally very, very good. particularly in years where the halvings occurred. So I think statistically, in halving years, about 45% of the gains for the entire year come in the last quarter of the year. So if that rings true again this year, then we're going to see some reasonably large gains, considering we've already had a reasonable gain from the start of this calendar year to where we are now, even though it doesn't seem like, because we dropped sideways for so long the last 6 months.
And if you look at it, I just love this chart at the moment. It's one of my favorites because we've got Bitcoin in the log scale, and you're seeing that rate of change in global liquidity, which in many ways is actually a clearer chart to look at to really identify where we are in that cycle, still ticking up. But when you look at all of this that we've been through for 2024, it just looks like nothing compared to what you see late cycle when you get these big moves on a log perspective. There's a lot of potential there.
Yeah, and it happens really quickly. So,
it's just green candle after green candle, isn't it? I mean, these are weekly candles, and you're seeing big moves just week after week after week. So that can happen, and you've got to be careful here that you don't get lulled into a false sense of, the market only moves these small amounts, because if you look at that, I would argue that period of time is abnormal compared to the rest of this chart.
Yeah, and
Joe, you could talk to. I mean, the Bollinger Band setup at the moment is phenomenal, right?
Yeah, super tight. And if you get, we're expecting an explosion either way, and we have to assume that explosion's to the upside. So, there's a lot of people waiting on the sidelines that are out of the market, just because, it's been choppy for so long. They think it's going to go down, and when this thing goes, the thing's going to be 75, 80,000 before they get back in the market. So it just goes to the old saying, it's about time in the market, not timing the market. That's how you're going to make money on this.
Yeah, because I'm looking back here, and the closest I could maybe find is a period like this. It broke to the downside there, but also look what was happening at that period of time. Makes sense. But you very rarely have long periods where it's just being sideways of this magnitude. Everyone loses a bit of interest or thinks that's the way the market behaves now. But every single time we get proven wrong on that. So with the way this is looking compared to the way that's looking pretty exciting for the break to be to the upside. I'll flip over this chart, which is really just looking at it in without the logarithmic chart on it, seeing it's been really very resilient, hasn't it?
Yeah. So the previous chart's rate of change, this is total liquidity as an index, and it feels like we're in chopping sideways for a long time, and we have been. But like I said, looking at those statistics for Q4, I'd want to be in the market, not waiting here.
And if we, like, I've zoomed in a little bit closer, Paul, I'll ask you about this one. We have our cycles, our sort of cycles that we use the work of Bob Lucas on, and there's debate over whether this is a new high or low, or whether we count the spike down in the tail that you get on that wick. Probably doesn't matter too much. How do you think about this when you look at this period here where we're sitting right now? It's obviously moved up, right? Like we've bounced off that low. Does it necessarily head straight up higher from here? Is it going to come back down and test? I mean, we at the end of the day probably don't care too much, but how do you use a tool like this?
Yeah, I don't get too caught up in the short term, but when I'm looking at this, what I'm looking for is a higher high of some sort. It doesn't have to be the all-time high, but because that we can argue ad nauseum about whether that red candle down was a low, and now we're at a higher low, which could be the start of this. So I'd be looking for for this to go at least above that previous high. Probably not to an all-time high this time. That would be a bit too much to expect. Have a rest, and then probably the next cycle get that all-time high. But I'm just looking for a higher high after those 4 declining highs that we've seen and 4 declining lows. That is the one I'm looking out for. And
good point there on probably or likely not this 60-day cycle, but we have to remember that's only taking us into November. We're still talking late this year or early next year that we could be seeing those all-time highs if you just move one cycle further into the future, possibly earlier based on what Joe was saying about seasonality too. So lots to play for there. But
an election you might have heard of in November.
Well, and an election that's only just over a month away. It's all happening there. Joe, this is a new one chart that we've put in. It's become one of our favorites. We've been looking at it quite closely. Can you quickly step us through what we're looking at here and what it might be telling us about the very short term of what might be happening next?
Yeah, so to clarify, it's the chart's labeled market liquidity clusters. So liquidity being within a specific market as opposed to global liquidity, the global liquidity index, which we track, which is money in the system. So just to clarify those two things. So basically what this chart is showing, obviously you've got the price action there, but then you've got bars below and above the price. So bars below are effectively derivative exchanges where longs have their stop losses in.
Mm-hmm.
So people who are betting the price going up have their stop losses on. And the orange at the top there is people who are short who have their stop losses in. So what we've found, and if whoever's watching this may even want to just pause, if you look historically, the price is actually drawn to where those liquidity zones are, which means that generally speaking, the darker the line, the more liquidity there is, which means the more people that are going to get pushed out of the position. So I find it useful because the market always seems to deal the most pain to the most amount of people. And if you can see a large position being built up on one side, the price usually gets drawn into that area. That doesn't necessarily mean that, for example, on this chart, we're going to go down to 48 or to 52, but based on today's price action, you could expect it to break down to 61 or maybe just above 60, clear out the liquidity before you get a reversal to the upside again. And yeah, that's just something we monitor now just to set expectations in the short term. Not that we necessarily trade. I wouldn't recommend it as a trading tool. It's just to give you a bit of an idea of where the market positioning is.
And right now we can see that if you were just looking at this completely objectively, there's more sort of bars above. There's a bit more liquidity above, which would be a magnet attracting that higher. But like you said, we're right near. It wouldn't be a surprise to see it whip down, take out a few of these levels first before it attempted to take out the top. That would be that nice causing pain for as many people as possible that you were talking about.
It always happens. It always seems to happen.
It does. It's been remarkably accurate. That's why we're looking at it. A really good point you made. We're not trading off it, but it helps manage expectations. And a lot of this is a psychological game, right? So we've got to make sure we've got the tools in place to keep our psychology right on it. Speaking of psychology and keeping it right on it, Paul, gold has been interesting of late. It really has just been on a tear. It really hasn't pulled back as many have expected. Is this more to do with the geopolitical play? But I mean, there's certainly a lot going on in that space. What's your read on gold at the moment?
Look, it's all about liquidity, right? So I think the market, and just that chart's sort of 2470 or something. It's shot through 2600 a couple of days ago. So
this is the average, to clarify, the average price of the month, which will be the average of August. And yeah, like I said, it's taken off again.
Yeah, so we're 2620 at the time of recording. Well, look, we've seen a number of things. The central banks are still buying hand over fist. We're actually starting to see ETF turn around. Remember, the ETFs were a drag on gold. So that's turning as well. There's the continuing geopolitical situation and the rate cuts, so people can see that that carry trade part, so that historic real interest rate component is coming out to play as well. So there's a lot of supportive stuff there. It's had a pretty good run. You'd expect it to at least have a rest for a bit around here, but it keeps defying that. So it's looking through. It's definitely looking through, and there's a lot of people positioning themselves to for what they think's coming.
It's certainly a great setup when it's this strong already in the cycle, when we were still debating before how low liquidity was overall. Silver, I mean, it's certainly picked up from here as well, but that lag we always talk about, potentially, if we see that liquidity coming on stronger, you would expect later in the cycle it to really play catch up in a significant way.
Yeah, again, at the time of recording, we're over 31.15 or something right now. So silver's had a really good few days. So, typically when if you're like me, you wake up in the morning, you look at the price, and, if gold's up 1%, silver's been up 2 or 3 in the night. So it's definitely definitely playing catch up, and we'll see that gold silver ratio start to decline as it. But it's still a late cycle phenomenon for that to really play out. I don't think we're in the late cycle. We're still relatively early. So for me, I think silver will just hang around this space, and then we'll see that GSR really come down.
This monthly macro and global liquidity analysis is brought to you by the Ainslie Group, Australia's trusted choice to buy gold, silver, platinum, and crypto online or in our Brisbane and Melbourne showrooms. With over 50 years of operation, we're your reliable partner in wealth management. If you're looking to buy tokenized gold or silver anywhere in the world, check out the Gold and Silver Standard, the security of real-world precious metals combined with the flexibility of blockchain. Okay, we always do this. We keep a track on this trade that we've been playing specifically in the Bitcoin market for people who were following along, sort of providing some value there, hopefully. The idea is buy low, sell high, pretty straightforward strategy there. When we're really confident that the low of the global liquidity cycle is in, we place that buy. When we're confident that the high of the global liquidity cycle is in, we want to take that profit. And our buy was back in, the global liquidity low was in October 2022. We were confident on the buy in January 10th, 2023, and we've been heading up ever since then, hopefully about to head up a lot more, resulting in our gain currently of 270% over the last 622 days. So that is 158.6% annualized and potentially about to get a lot better even than that. So very exciting on that trade. We'll continue to hold that, and you can watch that in real time each month as we update it. All right, so that's gotten us to the end of the analysis, and we've covered all of those charts. As we do each month, I'll sort of ask everyone for their sort of final thoughts or opinions going forward, any closing remarks or anything else they want to add. I'll start with you, Joe.
I think looking at our data and putting it all together, we really are in, I think we even said it last month, episode, we're in the Goldilocks period where inflation's under control, growth is not falling off a cliff, and global central banks and governments want to stimulate. So there's only one direction that liquidity is heading in that situation, and that's up, and that's going to be fantastic for asset prices, particularly Bitcoin. And when we talk about seasonality. So yeah, I'm quite happy with how our views over the last months have been accurate. It's taken a little bit longer to play out, but I'm very comfortable with where we are.
Final thoughts, Paul?
I guess a closer look at central banks. I get the feeling they're about to start easing more, and really a reminder, we're in a US election year that just historically has always dished up serious gains in this next quarter. So both candidates, arguably a Democrat outcome is better for our assets because there'll be a hell of a lot more fiscal spending and whatnot. And Trump's a bit of a mystery in terms of how that plays out, but he's definitely been shown to not mind a bit of a spend. So I think there's just a whole host. It all seems to be coming together in terms of what we've been talking about for months now. That and we've looked at Q4 for some time, and so this is the time that I think we're really going to start to see this play out.
I completely agree with all that. Q4 is getting very exciting. I think particularly that September so far, Paul made the point before, it's not, we're only still halfway or a little bit over halfway through. So maybe don't get too cocky just yet, but the terrible September just hasn't happened as far as I'm concerned. And it's all looking very positive. If that's sort of the lead into a really, fireworks Q4, then it's pretty exciting to see what we'll be talking about in a month from now. And we'll be very close to that election. Volatility is likely to pick up around that. So lots to play for, lots to be paying attention to. But overall, looking very positive for those assets, particularly Bitcoin, I think, over that next period of time. So I'm excited about that. Thank you to everyone for watching, and thank you to Joe and Paul for your contributions today. Really appreciate all that.
Thanks, Chris.
No worries, Chris. Thanks for having me. Awesome.
As always, we value feedback, so you can follow me on X at Tipper Analytics if you want to stay up to date or to reach out. We'll be back in October with the next monthly update to reassess and identify what has changed. Until we chat again, good luck in the markets.